We all want to achieve financial freedom and generate wealth. One of the best things you can do is to start as early as possible. At the end of this video, you will be convinced that you need to start investing now, and you will understand the importance of time when it comes to investing your money and how it compounds over the years. One of the major benefits of starting early is compounded growth. So you can basically take your investment and then the returns from the investments get reinvested into more investments, which in turn will increase your profitability over the years. So you can use time as an advantage to keep growing your wealth over time. Let's look at Elon Musk as a really good example. Elon Musk, at the age of 31 years old, sold his business PayPal for $176 million. Then he reinvested that money into different companies like Tesla and SpaceX, which he was able to compound the growth of that investment into these new companies and grow them to $227 billion, growth of 1,289 times his investment. He was able to accomplish this because he got the money out of his initial company early on and reinvested that into more companies and over time grow that in a way where it became exponentially profitable. And how about Warren Buffett? Warren Buffett made his first investment at 11 years old into the stock market. And at a very young age of 14, he invested into real estate. So we can see he's been investing for a very long time. Because he started at such a young age and used compounding to his benefit, by the time of 90 years old, which is now, he went from $5,000 in net worth to $109 billion in net worth. Now, I want to explain to you the power of compounding based on some real life numbers. Let's look at a scenario where someone invests $500 on a monthly basis into some sort of a financial instrument that gives 10% return. And this 10% is reinvested on an annual basis. If you started at an age of 20 years old, you would have a profit of $4.24 million by the time you retired. Now, if you started at 30 years old, you have profit of $1.48 million, which is still not too bad, but it's obviously a lot lower. Now, if you started at 40 years old, retirement, you would only have $466,000. What is more interesting here is that if you started at 20, you would have only put in $120,000 more into the investment than someone who started at 40 years old. But the difference in profitability is equal to $3.773 million. And so although you're only investing $170,000 more dollars over the years, you're actually looking at almost $4 million more in profitability, which can be associated with starting early. The other main advantage of starting early is that you can get over the learning curve earlier. Proper investing is a skill and it needs to be learned. There are different types of instruments. There's different ways you can invest. The amount of investments out there are unlimited. And for you to learn these and make the mistakes and then correct those mistakes over time requires you to start early as well, which gives you a huge advantage. The last thing you want to do is watch this video and go and put your life savings in a penny stock. That's a for sure way of losing all of your money. We have to understand that there's a difference between gambling and investing. Investing is educated and it's based on a system that you formed or you are following someone who is an expert at that system. And through patience and over time, you grow that wealth into something that is bigger. Whereas gambling is something you might pick up right away and put all of your money in. And in the longer term, statistics show that gamblers will never really succeed. The house always wins. Even when you study and invest, you are prone to making some errors. Starting early allows you to bet bigger and make some errors, but still be ahead later on as you learn from those errors and implement them into bigger investments more confidently. Investing gives you options and allows you to create financial freedom. When we're younger, we tend to believe that life will always be in this way. You don't really think too much about money and you kind of just spend it on things that you like, or you might not think through thoroughly. What investments allow you to do is force yourself to save money in the long term, which will be beneficial as you get older. As you get older, you have less time and the investments that you have allow you to make bigger purchases and perhaps even allow you to buy some time by having passive income on the side along with your day job. For example, let's say someone starts investing at 20 years old. They invest $2,000 on a monthly basis in dividend stocks that give 6% return. And now this 6% return is also reinvested into the stocks. By the age of 40, which is still very young, they'll be able to get $1 million saved up in those investments. And these investments would be paying them $60,000 in passive income. Now, I know this is hypothetical and the variables can change, but the numbers are similar and the trends do show that this is actually possible over time. So as you start investing, which is hopefully as soon as possible, there are some tips that I would like to give you to keep in mind, which are generally given by finance gurus. Always pay yourself first. What this means is spend less than what you earn. That way you have money to invest and grow. Educate yourself to be able to make the right investment decisions. Read books, follow people who are of authority, who know what they're doing, and listen to their advice, and also do your own research before investing. The last thing you want to do is gamble your money away, your hard-earned money, and go nowhere. So it's really important to educate yourself when it comes to investing. Primarily, the best thing to do is protect your capital. Instead of going after higher returns, what you want to look at is how well is this investment going to protect my capital, and then you want to go after the return. For example, an investment that gives 10% return and which is generally very stable and safe is, in my view, much better than an investment that gives 30% return where most likely you might lose all of your money. Reinvest your money instead of using that for your own personal expenses. As long as you have a day job, this side income or side investments can be compounding. That way you can constantly keep reinvesting the money to make it compound even faster. Understand the role money plays in your life. Money is an important tool to have a happy life, but happiness doesn't just depend on money. You want to have a balanced life as well. Research shows that an average of $60,000 to $70,000 is enough for a person to be happy. Anything above that doesn't really increase their happiness. So, which means what are the other things that could make you happy, which would be a balanced life, a peace of mind, having less stress in life. So all of these things are very critical when it comes to keeping yourself satisfied. And the point of life is not to keep chasing after money, because that is an endless spiral that is unlimited. If you like my video, check out my other video above, which talks about pricing. But really what it's talking about is how to create value for people around you, whether it be clients or whether it be family or friends. And it's based on the Apple strategy that I've compared.